In December 2020, you wrote an article called Golden Advice Bet Against the Experts. So, how can millennials like myself use contrarian investing and gold ownership to succeed in today's unpredictable markets? How can the everyday investor apply your golden advice and bet against the experts?
Well, first of all, that's a very good question. Let me be clear. I don't think gold is the best investment. It depends on what you're looking for. If you're at a point in your life where you're trying to preserve the purchasing power of your current wealth, gold is a very strong investment. If you're looking for appreciation, it's not. There are other asset classes that could rise faster going long or fall faster going short. In terms of making money, gold is not the sexiest. Be very clear, gold is about preserving wealth, in my opinion, far more than creating wealth. You could look at junior miners or resource companies or other things like Ross Beatty or Rick Rule and make huge 10-bagger returns. But as Ross Beatty and Rick Rule will tell you, that won't make you rich in 10 minutes like my IPO did or like Bitcoin did for some. That is not a business model or an investment strategy to follow. Let me repeat, that was pure luck. For your generation, which are my children's generation in the late 20s, and I talk to them about this all the time. And there's two things I would say. Yes, a 27-year-old with years ahead of them who are trying to get into the markets shouldn't be stockpiling physical gold right now and hoping to get rich. A, it's very expensive. And if their goal is speculation and appreciation, although I do think gold will go up, it will only go up when things are going so bad. So when gold's at 5,000, the cost of a loaf of bread is going to be a lot higher too. Gold just is basically keeping your nose above water in terms of your purchasing power. In terms of investing for millennials, like I was when I was in my 20s, the way I was investing was by taking stupid amounts of risk because I was lucky and I was well connected and I had a rich business partner who had a rich father. So we had an easy time of it. We could have gotten our hands kicked in. We got lucky. We ended up making stupid mistakes, by the way, afterwards. Let me be really clear. We made some stupid investments afterwards in Hollywood, in sailboats, in horses. I mean, I did so many dumb things. I'm very open about it. But I learned as in my 30s, I did so many dumb things personally, financially, mentally. It was stupid. It was like a rock star without the paparazzi, just thinking I knew everything. But in terms of what I tell my kids today, I have one strong version, and it's the dumb advice that our fathers and grandfathers always gave, which nobody listened to, including myself. Never buy at a top, buy at a bottom. No one does it. Everyone says they will, buy low, sell high. Right now, markets are nearing all-time highs, and people are fear of missing out or chasing that. It's very grandfathery, condescending advice to say, kids, don't chase these tops because they'll say, yeah, but I got this special alternative crypto, it's going to rip. Or I got this special SPAC, it's going to rip. Or I got this inside deal, they're going to do an M&A, and it's going to rip. Do your homework. If you're in your 20s, what I tell my daughter is the most powerful force in the markets, at least until the Fed completely corrupted free price discovery. So there's a caveat there. But the most powerful force in the market is mean reversion. All markets revert to their mean. That means if you think of it like a rubber band on your finger, if you pull it up, it'll bounce down. If you pull it down, it'll bounce up. When markets get too low, they'll eventually correct. When they get too high, they'll eventually correct. Right now, if you look at the NASDAQ or the S&P since 2000, you had the bubbles, and then we're way up here. Look, I believe markets will mean revert. I have no idea when. I have no idea what the trigger will be. Will it be another war, another pandemic? I also know that the Fed will do its very best, as they did in March of 2020, to put trillions of fake money into it to save the market. So it's one big nationalized 401k. But at some point, there's not enough money printing available to bail out the system. And I don't know what that point is. I do believe that markets mean revert, though. And by the way, I'm very, very bearish on the Fed and markets. But when the Fed started printing money in 2020, as bearish as I was after the markets were down 36%, I knew the Fed was going to print money. I went long all day long on that market because the Fed was giving you a fake tailwind of trillions in liquidity. Of course, the markets were going to go up. You have to know nothing at all about oil. But when oil goes from $100 to $20, buy low. You don't have to even know the oil market because oil will never stay at $20 forever. Even in the new world order of ESG and all that, oil, Saudi Arabia and OPEC are not going to let it stay at 20 this generation. In other words, you get a fat pitch, swing. And my point about your generation is getting away from the gold argument, because that's a wealth preservation, not a speculation asset. For people who are trying to make money, again, this is what Rick Rule would say. This is what Benjamin Graham would say. This is what this is what Buffett would say. And I'll say it: buy low, sell high. Well, thanks a lot, Matt. Markets are all-time highs. It's not going to help me. I tell my daughter, my son, be patient. Be patient. First of all, there are asset classes right now that are very cheap in the commodity space. But as Rick Rule would say, your attention span has to be longer than 3 months, 6 months, or a year. You may have to wait 5 or 6 years on a well-researched mining play or a well-researched commodity play, like uranium was 3 years ago. No one was talking about it. Now everyone wishes they were. They're buying it at a high. If you thought about it, the way uranium investments are going, it was a fat pitch 3 years ago. Now everyone's trying to cap in on uranium. It's too late. Do your homework first. In terms of the S&P, the NASDAQ, and the Dow, well, it's obviously too priced. It's too overpriced. You've got the Magnificent Seven, 7 companies, corporations. They're 30% of the market cap. That's not an S&P 500. It's an S&P 7. That market, that rubber band will mean revert at some point. You'll never know what the bottom is, but it will mean revert. It'll probably correct again when the Fed prints trillions more. But wait for markets to correct by 30 or 40% if you're going to just buy an index. Or if you're looking at a specific company, do your homework on the company, on the balance sheet, on its investments. Don't just buy what's being sold to you. If you really are looking to speculate and make money in these topping, frothy, grotesquely overvalued markets, you better look for something that's unloved and also valuable. There's plenty of stuff, even in the junior mining, that's unloved because it's unlovable and crappy and it's producing nothing and it never will. And it's surviving on debt and crappy bonds and eventually will tank. But there are companies in different sectors that you have to figure out for yourself, whether it's in energy, whether it's in commodities, whether it's in precious metals even, or other alternative metals that are unloved but have good balance sheets or good future potential. If we have a global recession, commodities are not going to rip right away because it's no demand in a global recession. But buy something unloved that has inevitable value and wait more than 5 freaking months for a return. You've got to have conviction. Look at something for 5, 6 years out. But before you put 10,000, 5,000, or 100,000 into that investment, you should do your homework, find your mentors, look at the space. And when you're absolutely convinced that it's perfect, then find someone who has the exact opposite argument and read that very carefully too, including gold. If you don't think gold's a wealth preservation asset, if you think Bitcoin or Ethereum are better, go read the guys that tell you that. See what they have to say. Don't just listen to me. I've read them too, but here I'm trying to be a fiduciary. Look at everything that I'm saying and question that. But I would say to your question, don't wait for a .com lucky strike like I got. Don't wait for another Bitcoin to get you rich. The volatility is amazing in that. But again, if you're in it, great. Be realistic. If you're looking for the next opportunity, I know this sounds like old man advice, and I didn't even take it in my 20s. I got lucky. But if I were doing it now, wait for mean reversion in the broader indexes, or if you're looking at a specific sector, whether it's uranium, copper, or silver, or a mining company, or some other energy, or some other industrial, or some other, you could even look at electrical plays or consumer staple plays. Find the most unloved stock or asset or sector. See what its potential is. See what the cash flow is and wait it out. If oil ever goes below 20 again, buy till the day goes long because it's going to go above 20. It always will, at least until we come up with a magical battery that comes up, ESG be damned. We're going to still need carbon for a while. I'm sorry. And that's not about environmental politics. When you see those moments where every now and then the market gives you something, be patient. I joke with my son, when you go hunting for pheasant, you don't just walk into the woods with the 12 gauge and start shooting at the trees. You wait for a pheasant. You got to be patient. You may go 4 days in a row and not see a pheasant, but don't just start shooting. When you're young with money, don't just start throwing money at every SPAC or every crypto or every new sector or everything you see on YouTube. Be patient. Do the freaking homework. If you're going to be good at a sport or an individual asset class or the markets, you got to train. You got to train your mind, your body, your thinking. If you do the work and then you have conviction, then question your own conviction and then put the money into it. But make sure you put the money into whatever that is when it's got a good value. That's Benjamin Graham. That's Munger and Buffett. That's still Matt Piepenburg, even though I got lucky on an IPO. I didn't even know what the company did. I didn't care. It was throwing a dart at the NASDAQ. I'll admit it. I didn't know anything. But then I got smart. And then I got stupid too. But everyone I know has done both. But now that I'm older and grayer and wiser and sorer, I'm much more cautious about preservation. So I don't think gold for a 28-year-old is going to make you rich overnight. It'll protect the value of whatever money you have. So I'm not here to recommend that to everyone. I do think everyone should have some allocation to gold. But again, that's Matt talking in his book, but I don't think so. I think it's just common sense. But for speculation versus preservation, come on, do your homework, find an unloved asset class that has a solid balance sheet and a narrative for the future that's undeniable. and go long, but do the work before you put the money into the account.
I really appreciate, that golden piece of advice, very detailed answer. But I want to just move to one of my final questions, which is, what do you believe separates a good investor from a great investor? How do we go from good to great?
Yeah, there's that. What was that great book? Like Malcolm Gladwell. I can't remember which one it was. Or sometimes it's just the generation you're born in, the circumstances. Sometimes it's pure luck, but that of course is not enough. It's like Napoleon also said, fortune is blind, but it's not invisible. You need a little bit of luck. I certainly got luck, but to get luck, you have to be in the space. And to be in the space, you have to take some risk. So obviously luck and risk are a part of it, but you can't just obviously say that luck and risk is what separates, Jeremy Grantham from some average hedge fund manager, or Paul Tudor Jones from some average hedge fund manager, or other great funds, the Elliots, the great funds, the Richard Perrys, the Millenniums, the good investors, the KDPs. The great portfolio managers that I knew were not relying on luck and risk. And the great portfolio managers that I knew did look at risk first. What separates, I think, the great from the good is patience, real deep knowledge, and people are afraid of that because that requires responsibility. That requires you actually having to go for. You can't just read broad books by Ben Graham or Michael Lewis to know the markets. You're going to have to look at boring books on balance sheets and free cash flow. You have to look at the Fed switch, because when the Fed is hawkish or dovish, the markets are bullish or bearish. Sadly, the Fed is more powerful than a balance sheet today. But if you really want to be a great investor, you're going to have, like, if you want to be a great soccer player, you better spend a lot of time working on your left foot and your right foot for hours when no one's looking. It's like I spend hours on a horse on the left side, near side, offside. No one's looking. Whether you're in water polo training, whether you're in gymnastics, whether you're in tennis, it doesn't come just because you think you're a good athlete. You have to put in the time. If you want to be a good investor, you got to listen to more than a couple of YouTube videos. You got to read more than a couple of books. You got to find a sector that interests you. And then you got to become an expert at that. And then you got to have patience. Sometimes you'll be a lucky idiot and just make money by accident and think you're smart, which we did. And then we ended up pissing the money away in other dumb investments because we didn't know anything. We were just lucky and then dumb and then smart later. It's like a Hegelian process of overcoming ourselves. But you can avoid a lot of those mistakes by actually putting in the work now. Again, I think the metaphors in art, in sports, in romance, and in markets are the same. If you put in little work, you'll get little return for a few jolts of pleasure. If you put in longer work, longer commitment, you'll get longer returns and longer satisfaction, and you'll feel better about it. Of course, I wouldn't mind buying Bitcoin at $10. I wish I had, but I wouldn't feel that smart about it. Just incredibly lucky. But I think the great investors I knew all had stories that were sublime and ridiculous, with their moments they were on their knees trying to figure out what they did wrong, and then they learn from that. And then what they learn from that is, boy, I've really got to manage risk better. I've got to learn my asset class better. And they taught me three things. Once you get to a certain level, whether you're a trader or an investor longer term, is the three things you absolutely have to avoid. I learned this the hard way. Don't try to time the markets. Timing risk is a huge issue. Never concentrate in one asset class. Don't put all your money in one asset class or one stock or one position, and never use too much leverage. So timing risk, concentration risk, and leverage. I've seen a lot of hedge funds go down that way. I've seen family offices go down that way. The big joke in the family office space is you can make a small fortune easily. All you got to do is inherit a large fortune. If you inherit money and then have no responsibility for it, that large fortune becomes a small fortune. If you invest in something with no respect for leverage, concentration, or timing risk, or no respect for the due diligence it takes to bullshit detect the guy on the other side of the desk, always bullshit detect the other side of the desk. It's never that easy. Nothing is. And then every now and then, if you're patient and you're knowledgeable, when you're patient and you're knowledgeable, you'll see that fat pitch when oil dips below 20, or when a sector goes way undervalued. You'll grab it and you'll invest. But the only way you can see a fat pitch and swing is if you stood before a lot of pitchers and taken a lot of strikeouts, because you know how to look at a fastball or a curveball or a slider. You've got to put your time in the batter's box. You've got to understand these markets, and then you'll see the opportunities. If you're just waiting for someone on YouTube to give you a gloom and doom report or the get rich quick report, you're going to get slaughtered usually. I always say that's, as Rick Rule would say, that's just liquidity from the suckers for the big guys. That's the plankton for the whales. Nothing's that easy. I got it easily. Then I got burned. Then I had to start all over again and make more money again. But then I learned it was about hard work. So my successes and failures taught me more than my successes. And then I think I became more sober and more successful. But yeah, I know that's a Pollyannish answer, to do the work, but I've never seen a simpler way to say it. Just do the work.
A question that I ask all my guests on my show that I want to ask you is, what is your definition of greatness?
Well, it's a great question too, guys. I think I've always looked at so many different curious things about greatness, how man and women behave under pressure, whether that's in combat, whether that's in art, whether that's in families, whether that's in money, particularly in extremely important pivotal points. But I think more than greatness or grace under pressure or learning from your fears to overcome fears, what I think is greatness is success. And I think success has nothing to do with money, nothing to do with returns. And that is an extremely condescending answer from someone who won a lottery ticket. That's philosophical. I think it was Frank Sinatra who said, I've been rich and I've been poor, and trust me, rich is better. I get it. I get it. No one wants to feel sorry for a guy with polo ponies in a house in the south of France. And I'm not even that rich, but I'm saying I'm not struggling like most people. And I've seen them in Ohio and Michigan and Virginia. They're trying to get through the month. So I do think money matters. But let me say this, my experience of success has nothing to do with what money can buy. I know that sounds really cheap, really Pollyannish and easy to say. We all need a roof over our heads and food and a basic freedom from that terrible anxiety of trying to get through the month. I have tremendous respect for people going through that. I've been through that. It's no fun. So I do think financial security at a rudimentary level is incredibly important. What I learned from my quote unquote success as a 20-something knucklehead.com millionaire, that the Ferrari or Porsche or whatever it is you think is going to make you happy, or the big house or the swimming pool, or the friends that you make when you have money, and the friends that you lose when that money disappears, the men, the women that come and go depending on your stock value. What I have found, greatness, what success is, they're usually invisible things. That inner peace that comes from taking risks, from taking responsibility, from committing to something or someone bigger than yourself, whether that's your wife, your husband, your kids, your animals, your family, your art, your creativity. I know in my last breath, whether that's in Zurich, the south of France, or God knows where, I will not be worrying about the cars I bought, the houses I lived in, or the hither come lately, fair weather friends that came and left. The thing I will remember are those few connections with my dog, my horses, my friends, my family, the people that really were there for me in good times and bad times, those invisible sources of wealth. I think that is greatness when you start to value that, because what wealth taught me in my 20s is wealth isn't everything. I learned that was like the best lesson, is to actually get over that illusion early. That said, there's nothing worse than worrying about week to week survival, especially when you have children or a spouse, or, I don't want to ignore that problem. And I certainly would say to people, get that solved one way or the other first. Live within your means to the extent you can. I know it's hard as things get harder, especially for the middle class. It's very easy for some guy with polo ponies on the wall to talk about money doesn't matter. I really respect that that's not true for everyone. You need a basic amount of money, but don't think that when you suddenly have money that that's going to solve all your problems or make you happier. Because again, your question, greatness is invisible wealth. It's not paper wealth. It's not gold wealth. It's totally intangible. It's like Saint-Exupéry said, the essential is invisible. And the only way I think people really realize that is once they've already had money and they're still miserable. I can't tell you how many wealthy families I know who are not happy. So don't just think a return or a 10x is going to make you happy. That said, I do respect completely that you've got to get past that part where you're underwater all the time. And be careful, because the desire to get out from being underwater can make you take too much risk, and it just puts you further underwater. So manage that risk. Usually if something's too good to be true, it is. You got to make money quietly, carefully, patiently. Again, I made money by accident, so that's easy for me to say. But I did lose a lot of money afterwards and did eat some humble pie and had to start over again. And that was slow, steady, and responsibly. And that was the best lesson I learned. And then even after watching money come and go, I'm glad the people in my family and the friends that I have and the things that I love give me far more meaning than my portfolio.
Thanks for, sharing with my listeners what you think about greatness. Who is a future guest, someone that you know personally that you would love to see on this show?
Oh, wow. Someone that I know personally. Um, Gosh, there's so many. They're not people that necessarily stick out in the financial markets. I know people that have come through cystic fibrosis or cancer or combat. I'd like to see a couple. I mean, I don't know if I should say it out loud. There's some as a Navy SEAL or two I know I think are far more important to America than I am. There's a couple Marines I know in Virginia were far more important. There's my business partner who nearly gave up his life in Vietnam, who are far more important than me. There's a few. None of them are, by the way, hedge fund managers. None of them are bankers. Uh, right here in France, I have a friend who's, again, I'm not trying to be Pollyannish. He's an apple farmer, and his neighbor is a cattle farmer. They're getting brutally taxed and screwed here in France. So they work harder than anyone I've ever met in New York. I think they're more interesting. They're in French. They're not in English. Um, Gosh, I know yeah. If you want me to give a specific name, I might embarrass them in case they want to be named. I honestly think probably my hero sadly recently passed away. He was a combat pilot in World War II. He was in his early 90s. He's gone. He would have been great. I'd have to think about that. But I would probably tell you, and we can follow up on this by email because I don't want to give their name in case they're uncomfortable. I will say it's probably someone who's had to take real risks, that is, serve their country, and probably someone in the military that I would probably recommend because those are the people. A lot of them, just like in Wall Street, it's the lower middle class that get drafted. They're the fodder for our wars that older men make and younger men have to fight. I always say they're lions being led by donkeys, but they don't ask a lot of questions. They serve bravely and then they question later. But they are more interesting to me than anyone I've met in finance, because again, most people in finance are in it for themselves and that fee structure. Uh, Probably either a professor or a soldier or a farmer. And again, that sounds like I'm just placating, but it's actually true. And I'm from the Midwest, which were mostly farmers and soldiers and teachers. The ones that have had the biggest impact on me were all three of those classes of people, whether it was at fancy Ivy League schools or high schools. Um, I think, one person I know would come on who's from my hometown is David Stockman. He's a former congressman, and he was the budget director under Reagan, and he can tell you about debt and distortion. He's getting older. I could reach out to him, but he's a person in the financial markets who's from a small town in the Midwest who gets debt and gets the nonsense because he was literally right in the heart of the beast in Washington, D.C. when we were blowing up our balance sheets to quote unquote recover our economy. But yeah, I'm sorry I'm dragging this on, but I'd have to think about that. But I mean, David Stockman would be great. He's just getting older, Egon von Greyerz, obviously, he's my mentor in the precious metal space, but I'm afraid he's just going to say everything that I've just told you. You've already interviewed Ronnie Sturfel and Grant Williams. Those are guys whose opinions I admire a lot, a great deal. Rick Rule, another guy who's put in the time in the gold space and the precious metal space. Uh, uh, Gosh, Bob Moriarty, another great investor, Vietnam veteran, lives here in the south of France. He's someone I would recommend too. Like there's there's plenty of if we could follow up on, but I'm happy to help with that.
Absolutely,
Yeah.
Matt. Well, I really appreciate, those list of names, very generous, and also list a feel of kind of the type of people that you love to be on.
Yeah.
And I really respect too that, you kept some of those names private for now. So I appreciate that. So before we sign off today, where's the best place for my listeners, to connect with you or follow your work online?
Sure. Yeah. I mean, obviously, Egon von Greyerz and I and our team, it's now called von Greyerz Gold. We were called for many, many years Matterhorn Asset Management, but Egon von Greyerz is the founder, his values, his example. We really thought after many years, we should just name the company after the founder and chairman. So The website for that was goldswitzerland.com. It's still goldswitzerland.com, but it's also von Greyerz.gold. So you can go to that website, and on that website, you can learn all about gold, all about our books, all about our thoughts. There's a section on why gold, which you can read about the banking risk, the politics risk, the currency risk. Again, inform yourself, be skeptical, be critical. All our articles and interviews are on there as well, on an insights page. So if you just go to goldswitzerland.com or von Greyerz.gold, you can see a lot of our articles up to date. All our interviews are there. And again, go through it, make your own decisions, make your own opinions. You know, we're not salesmen. We'll never push on it. If you want to contact us, our minimums are very high because our clientele is high net worth, because we can only focus on specific clients. We handle each client individually, so we can't take hundreds and hundreds of thousands of clients in retail gold. So we sell for a very high minimum. So anyone who wants to be a client, they can reach out to us. We will never hound you, never call you back unless you ask us to. We just are there to answer questions. We've never really had clients leave. They're sticky because they're just buying gold as insurance for currency risk. So it's an interesting business model. It's a great business model, but it's a great set of clients. It's a great set of partners. And all of that can be found on that website. So you can learn all about it there.
I appreciate that, Matt. And any last words that you would like to leave with my audience?
Well, again, stay curious, stay cynical, do the work, and even laugh at me, because it's easy for me to give advice when I got lucky in my 20s and then to give advice about how to work hard. But despite all that luck and stupidity and the dumb things I did in my 30s and 40s, I did always work really, really hard. Whether that was in sports or in school or in investing. I come across kind of flippantly, but do the freaking work, do the work, learn something. You may not always be right, but understand something. And if you want to understand investing, you got to do the work. And you don't have to make the same mistakes a lot of us did when we were thought our luck was intelligence. But some of these principles, I think, that are what I've talked about, that Ben Graham talked about, that Munger and Buffett talked about, that Egon talks about, that Rick Rule talks about, that Grant Williams talks about. They're all very similar. It's not because we got together and decided upon this. We all had the same experiences. It takes longer than a .com stock or a Bitcoin investment to get rich on the markets. There are areas of real landmines, but if you really, really care, then really do the work. Like you were studying for, a law degree, get into it, spend years really understanding markets. Start with the central banks, start with bonds, look at specific asset classes. I would definitely understand free cash flow. I would definitely understand balance sheets. I still think that matters, despite the fact that the Fed, more than any force right now, is the tailwind and the headwind for these markets. And that is something you need to understand too, because that's disgusting that the Fed is the market today.
Well, I appreciate those last words, Matt. And thanks again for your time and your wisdom that you shared with my viewers today.
I really enjoyed it. It was a great, great pleasure. I'm honored to be on here. So thank you.